Hi everyone, I hope everyone is doing fine. So today I just wanted to discuss a report wherein the quarter 4 earnings preview has been shared and various sectors has been discussed in that particular report. So we'll be discussing the nuances which has been discussed in the report so that we get a broader view what's happening across the sectors and which are the sectors one can think of devoting more time and which are the sectors obviously one need to be very cautious whether the earnings will be on expected lines or below that. So broadly, if you talk about the sectors wherein we can expect strong operating profit growth are auto OEMs, retail, cement, oil marketing companies, pharma and textiles. Contrary to which agrochemicals, metals, building materials, utilities and FMCG are some sectors which appear to be laggards as far as the earnings of quarter 4 are anticipated. So in those lines, there are certain sectoral trends which we would be discussing here. So basically, if you talk specifically about the industrial sector, so they are expecting good revenue growth, and since the supply chain has normalized and the execution has appeared to be swift, so this sector looks like it will be coming out with the good revenue growth, and we can see similar thing in the earning also. But as far as monitorables are concerned, so capex outlook, and we also need to see the ordering activity, be it domestic or international, and on the top of that the main aspect is execution, right? And also we have to see in lines with the upcoming elections. So that is as far as industrials is concerned. We can also talk about railway companies wherein the similar stance is that this quarter will be kind of softer one owing to the higher base scenario in the previous quarter, and again the same set of monitorables, be it the capex outlook, ordering activity covering the domestic and international, and on the top of that execution is very important, be it any sector. And in the defense sectors we are hoping for a strong revenue growth, although the margins appear to be contracting. But again we need to see the changes in the revenue mix which are happening, and also we also had a higher base in the defense companies also, so that needs to be taken care of. So as far as you infrastructure is concerned, specifically the capex spotlight in the infrastructure sector is driven by the work in water, road, power and railways. So this sector although is expected low teen earnings growth, but since we are doing very good as far as infrastructure is concerned, and even the private capex has also started, and we can see more momentum going forward after the election. So this is one sector which cannot be missed by the investors. So definitely one should see the companies which are directly catering to this, and on the top of that the better aspect would be to look for the ancillaries which are catering to these sectors wherein more money can be made comparatively. So as far as utilities are concerned, so you do not expect much on that front. So basically mid single digit growth is expected in the utilities sectors. And for the real estate sector, which has been the talk of the town lately, and the companies had been doing well. So on the expected lines, most of the companies to end financial year 24 with the record sales booking numbers, as we see strong momentum in both new launches, and the pre-sales are continuing. So definitely going forward also that will add to this sector. So this is one of the important sector we should look at, but also we need to be cognizant of the fact what had happened in the sector prior to the consolidation which happened in this sector. So those things should also be kept in mind. So building material is something which is very important, and since infra, real estate, so all the sectors being catered by the ancillary companies in this segment, and especially the pipe. So you need to be very you should devote some time studying those companies and see if there is any value available, basis which you can definitely make an informed decision. So in the pipes or maybe the building material companies, the double digit earnings are expected. So although there would be some decline owing to the higher base previously, but that is one pocket you should not be missing out. And on the auto OEMs, obviously they had it is anticipated that they'll report strong PAT growth, and the revenue growth will also be primarily led by the higher volume growth in the two-wheelers and personal vehicles. And since there is some as far as commercial vehicles are concerned, so we have seen some degrowth, and that is also maybe the rural consumption has not taken up to that level. So obviously after the elections we can expect some kind of uptick in that also, but that needs to be seen. And we should also be cognizant that we should be looking out the companies, the kind of product mix they are offering, and is there any operating leverage in any particular company which can be played to our advantage. Also in the auto ancillary coverage, the revenue growth appears to be flat, and as we see in the international markets, we are seeing weakness. So on the basis of that, we do not have much of what we say. So going to the weakness in international market, the margins are declining due to cost inflation and some price cuts. So those aspects should also be concerned when we see the auto ancillary space. And even in the FMCG companies, a softer quarter is anticipated with a low single digit growth, because there are hardly any visible signs of recovery, and the demand trends remain similar to the previous quarters, and especially as I was discussing, so the rural markets, the performance had been subdued so far. So that is one thing which need to be kept in mind. Although we are expecting a healthy quarter for consumer durable segment, and which has so basically in this, the pickup in the primary channel filing given IMD's forecast of above normal temperature during the summer season. So that is one aspect. So we are expecting that the summers are going to be more hotter than the previous years, and definitely as people obviously when the getting the coolers, ACs, this is something which is a part of everybody's aspiration, be it the tier 3, tier 4 cities. So definitely this is one sector wherein we can definitely see a healthy quarter going forward with the advent of summers. And we expect the hospitality industry, it should also report strong quarter 4 results, because be it the seasonality and strong prices, and although Q4 the occupancy is more or less flat in the Q4s normally, but again seeing the kind of demand, we expect that this sector should also do good. And even the retail demand momentum has failed to sustain the marginal uptick which was seen during the end of season sale, perhaps in December and early January. So possibly the spending pattern has changed, and people are more inclined towards tourism and investments in real estate and etc. So basically that demand momentum, when it will come back, so that need to be monitored before making any decisions about the sector. But this is particularly we are talking about the quarter 4. So these views should not be like uh, uh, changing your views of the investments which you are holding for I mean, with a view of on the longer time horizon. But again, this report appeared to be interesting, so I'm discussing that. And in the banking sector also, they are expecting that earning growth is supported by the strong loan growth and a benign credit cost environment. So basically, the demand and the loan growth has been robust, on the basis of which we can expect that this sector shall do good. However, the net interest margin is likely to moderate sequentially going forward, which could affect the NII and PPP growth. So we need to be like looking for the commentaries on loan growth and IM trajectory to see going forward how it will moderate or it will further pick up from here. So these needs to be seen. So as far as the demand for insurance is seen, it is picked up owing to robust equity markets, and data shows that there is high sales of ULIP, so which is like adding to that. But again, the VNB margin for private companies has contracted or appears to be like contract, and which would be deteriorating the product mix. So that aspect should also be seen from that lens. Also, OMCs are also expected to report a strong quarter, driven by the better core GRMs, helped by strength in gasoline and naphtha cracks and better marketing margins. So this is for the oil manufacturing companies. And all for other segment within the energy sector, it is expected that it would be a normalized quarter for the city gas distribution, although specifically Gujarat gas is showing some strength as Morbi volumes picked up in March after the price cut. And we are also like expecting a steady quarter for upstream companies. So gas utilities to report a strong quarter on account of lower input cost, and O2C to drive. I mean, this is specific to a company, so we can give it a pass. So yeah, so IT sector is one sector which everybody looks up to. So Indian IT service companies are likely to report weak revenue growth in this quarter, primarily by the verticals banking, high tech, and telecom. So these companies like had given a conservative guidance as far as their near-term outlook is concerned. So we need to see how the guidance would be there for the companies of the likes of Infy, HCL, TCS, wherein we can gauge how it would be for the mid caps and small cap companies, although we to an extent can gauge, but again entirely different ball game. So metal coverage. So the report says for the non-ferrous metal players, they are likely to benefit from lower cost of coal and higher coking coal cost, and lower steel realization to impact the steel spread. So this aspect should also be seen, although there is some momentum in the sector. But again, we need to be cautious because our entry and exit matters a lot as far as cyclicals are concerned. For pharmaceuticals, normally Q4 is the seasonally weak quarter, so that needs to be seen. But again, when we talk company specific, so the results and the performances are entirely different. So let's see how it progresses. And one sector which has been the talk of the town, which has not done well for a while, is the agrochem sector. So it is again likely to report a poor set of numbers due to weak performance in especially the export markets on account of sharp realization decline, slower volume offtake, and the impact of high cost inventory. And also, last but not the least, they expect that there would be some margin improvement for textile spinners due to improving cotton yard spread.